Today, a new year and so much to talk about with Tarric Brooker. Hello again, it's Martin North from Digital Finance Analytics, welcome to this post covering finance and property news with a distinctively Australian flavour. And I'm joined with journalist and data extraordinaire, Tarric Brooker. Hi Tarric, how are you going?
Not too bad, mate. How are you?
Oh yeah, pretty good. Just working through all the various things that I have to deal with at the moment. You would not believe the amount of administration that is to be thought about following somebody dying. It's incredible. But anyway, there's a lot to talk about with regard to the markets and the Fed and everything else, and not least, of course, the latest variation of the bug and what's going on there. So where do we start?
Well, first off, obviously, my condolences over your wife's death. There's really, no words that I can really add beyond that. And
appreciate it.
I know that I speak for the entire community when I say that. But on to sort of today's issues. There is just so much going on. There's the issues with what's going on in Kazakhstan, which could be potentially, a major seismic shift in markets, in geopolitical terms, and then there's just everything with the Fed, and there's even just the supply chain issues that are going on in Australia. Like I was at the supermarket earlier today, and there was quite a few empty shelves. Some things were very well stocked, other things were completely empty. You couldn't get eggs for love or money, and there was obviously a bit of a shortage of toilet paper.
I don't know what it is about toilet paper, but it just seemed to be the main thing. I was at my supermarket yesterday, and the same issues with lots of things not there. But I was watching the people in front of me wheel out this vast quantity of bog roll, thinking, what are they going to do with it all?
Well, it's kind of funny, people don't think about running out of food. They don't think about running out of all this other stuff. They think, oh, no. The first thing I need to do is ensure that I have enough toilet paper for the rapture, basically.
Well, that must be right. Yeah. Anyway, and look, I have a feeling that you could actually draw a somewhat similar bow towards what the Fed said in the most recent minutes, right? Because that set the cat among the pigeons as well.
It did certainly set off a bit of a panic in the world of markets, and all of a sudden it's like, oh crap, the Fed's actually talking seriously about taking away the punch bowl. And I think that the market is coming to the same realization that you and I were discussing about, I'd probably say about 4 to 6 months ago. I forget exactly when, but when we were talking about inflation becoming a political issue, it's no longer just, oh, can the Fed stand it? Can they take the pressure from the market? It's now the market, and in particular, yields in the bond market, feeling that pressure feeding through from politics and feeding through from the everyday American who is, suffering quite badly at the hands of inflation.
Yeah, absolutely. And interestingly, reading between the lines, it seems to me that there were a number of people in the FOMC that was more concerned about inflation. And, it's interesting that a few of them have come out and said, we should be lifting rates up and ending the easing program quite quickly. But I always say, words and figures differ potentially. I want to see some action, not just some words.
Indeed, and I think that we're probably going to see some form of effort for the Fed to try and buy some time. Now, so far, there hasn't been much sign that Omicron or anything else is going to be able to delay their tightening cycle. But that is something that I'm definitely watching for, because it's not hard to imagine the year-on-year CPI coming in weaker than it currently is later in the year, as we see those very, very strong months of inflation that we saw sort of mid-year last year and towards into like the end of Q3 last year, when we saw that those really big prints, those 0.8% month-on-month prints, even if it comes back to 0.6 or 0.5, which is still very, very high inflation, it could be enough for them to justify a little bit of patience and a little bit of, I don't know, shall we say, the usual behavior of supporting the market first and foremost.
Well, of course, the market's been banking on that for a long time. Hence the shock when they thought, oh, hang on a moment, maybe the Fed is serious. this time. And I guess the other factor to bear in mind is we've got, I think, the signs of what, let me call it, an unofficial close down or shut down, right, because of the latest variant. And certainly in Australia here, I'm getting lots and lots of stories now from businesses who are unable to trade, businesses who would like to trade but can't because they've got no customers. And it's a bit of the same in some areas around the world, including in the US as well. So it may well be that we actually have a significant economic shock yet to be recognised.
Well, if ANZ released a chart today that showed consumer spending in Australia, basically what's going on, in particularly in Sydney and Melbourne, which are hardest hit by the issues with Omicron, because case numbers have gone through the roof. Now, what's really, really interesting is in Sydney in particular, spending is now lower than at any other point during the entire pandemic. And that is, and this time there is no support really on offer from the government, because we blew all this money on JobKeeper, we blew all this money on the business cash flow boost, regardless of a company's actual need, and we just threw all this money at it, tens and tens of billions of dollars. And now we actually need the money. And, I'm unfortunately hearing businesses closing left, right, and center. And it's really quite sad, because there just isn't that certainty there. They don't know how long this is going to go on for. And they've had a really, really rough couple of years. And I really can't blame them.
No, and it's interesting. I did a quick show with Edwin today, who made the point that he's noticing a lot of properties that were meant to be open house aren't open house. So that may well be that we see limited listings rather than accelerated listings, which is what was expected before. And all of that might mean that the Reserve Bank will then sit on its hands for even longer and keep rates lower for longer than perhaps was expected. Now, that interesting when you overlay that against the upcoming election between March and May, right? So we could be in a really interesting situation by then if the economy continues to grind lower, as you say, without the levels of support that we had previously.
Well, I was looking at the RBA's rate tracker through the ASX website the other day, and I think it was yesterday. And I've actually got the chart later in the show. But we are seeing now a full rate hike being priced in for July. So if we do see US CPI surprise to the upside, if we do start to see greater and greater pressure on central banks, start to unfold, it's really not hard to imagine that rate hike being brought forward by the RBA to, June or even May, which would really, really put the cat amongst the pigeons for Scott Morrison. So, it's really a fascinating time, because, you could see a decelerating economy as a result of the virus. But by the same token, you could, if things do turn out to be better than expected and we do see more inflation as a result, well, then we could see a rate hike. So it's a bit of a catch-22.
And that's the point, really. And that's what I keep saying, that there are so many different scenarios that play out now, some of which are maybe more viable than others, but there is really no clear path forward. And there are so many variables and so many uncertainties that, it's just a matter of watching and seeing, I suspect. But you mentioned charts. Well, we should get onto the charts, because what happens? We spend all of our time talking about charts rather than doing the charts.
Well, and part of the problem today, to be honest, is that I have more than usual, because I literally couldn't cut it down anymore. There's just so much to talk about.
Go for it.
All right. Well, like this title of the show says, there's a lot to talk about.
Those cartoons get better and better, don't they?
They really do. I love them. Okay, now just put this up in the right spot. Okay, now there's a lot said about the fact that we're going to see growth continue to go to the moon, earnings are going to go to the moon, everything's going to be fantastic. And some eagle-eyed viewers might notice that this chart is actually from the last show of last year as well. But it's good to put into perspective just basically what's happening in terms of inflation dragging on growth in inflation-adjusted terms. And basically, it just shows that the US retail sales actually peaked around the time just shortly after the last stimulus checks went out. Now, what's really interesting about this is that we are actually finally going to see the US fiscal cliff arrive next year. Now, a lot has been said about the Australian fiscal cliff, and basically it wasn't as big an issue as it will be in the US, basically because we just threw so much more money at the economy and managed the virus that much better that there was basically just excess cash flowing around for longer and longer. But in the US, as you can see, as inflation-adjusted retail sales deteriorate, as other indices deteriorate, consumer confidence is extremely weak. Now, as you start to see those programs begin to end, like the child tax credit is worth 160 billion a year. That's coming to an end. The student loan repayment holiday is worth up to 200 billion a year. Now, I will clarify and say I don't know exactly how many people have continued to make those payments during this time. They don't have to, so most haven't. But I will say that I don't know definitively. But based on very, very rough estimates, these programs are worth 1.55% of GDP, which, while it doesn't sound like a lot, these are considered the smaller ticket items on the budget in terms of the stimulus being thrown at the economy. So I think that once these things are removed and you do take 1.5% of GDP out of the economy, things are going to get quite a bit more challenging for the US economy.
Yeah, and Tarric, the other point, of course, is that there is this other question on Capitol Hill about whether, in fact, Biden is going to get any of his additional stimulus through as well. It's looking more and more unlikely. So that's another reason why it may well be that the actual story is going to be one of reduced stimulus, and therefore the fiscal cliff gets really significant in terms of what's going to happen over there.
Indeed, and that's something I'm going to get to in the next slide. Now, this I put together is a comparison between Obama's stimulus, which he was absolutely just hammered for year after year after year. You know, Obama's debt, Obama's deficits. You know, blah blah blah. You know, hammered by the Tea Party, hammered by the Republicans. Now, the child tax credit and the student loan repayment holiday alone are injecting almost twice as much into the economy in a year as Obama's stimulus did in 2009, and almost as much as Obama's stimulus did in 2010, all on their own. That doesn't include all the other programs that they're engaged in, the infrastructure stimulus, the additional unemployment benefits, the aid to the states, the trillions and trillions and trillions of dollars of other stimulus isn't included. That's just these two. Well, I mean, they're very large programs relative to previous stimulus efforts, but two relatively small programs compared with the overall picture. So it really goes to show how large the fiscal cliff is. You know, I mean, people were worried about the fiscal cliff in 2010 and 2011 as Obama's stimulus fell away, and yet these two small programs are roughly the same size. So, you know, I think it paints quite a concerning picture in that regard. Although, by the same token, it's always possible that they could find some way to extend them and keep up the extend and pretend.
Well, make a really important point, right? So effectively, the momentum in the economy is fundamentally driven by all of those stimulus packages. When the tide goes out, we'll see what's left.
Well, exactly, and the truth is we don't really know how much is going to be left. You know, the US is still running, you know, very nearly World War II size deficits, and is going to be, you know, running large deficits for the foreseeable future. So, and not only that, but that's after the hardest point of the crisis has already passed. You know, this is all meant to be in the rear vision mirror. This is all meant to be perfect and wonderful, and I mean that's what Wall Street's pricing in. But I think it could be quite a bit more challenging.
Well, that's one reason why perhaps Wall Street is now beginning to get the shakes a little bit, because, that, as you say, they've been pricing for perfection. And in fact, there are still some people on Wall Street who still are saying everything's going to be fine, you know, earnings will continue to grow, et cetera, et cetera. They seem more and more disconnected from all the data that I'm seeing.
Well, I've got a great chart later from Macro Alf on Twitter, who has a really good chart that just shows how wrong they might end up being. This is what I was referring to earlier with regards to the inflation numbers. Now, if you look at, say, for example, June last year, inflation rose by 0.9% in the US. Now, when that feeds through later this year, when we get the June data and the year-on-year number, it's not hard to imagine, even if it comes in at, you know, a hot 0.6 or 0.5, you know, because of, say, for example, used car demand falls away, or, you know, some other form of inflationary pressure starts to come off somewhat. Not reverses, but just starts to decrease somewhat. And it's not hard to imagine year-on-year inflation surprising to the downside ironically. Now, I think it probably in these next few months, yeah, sure, surprising to the upside is well and truly, the sort of more likely thing. You look at, say, January, February last year in particular were relatively weak months compared with the rest of the year. So, from that perspective, yes, that is when you're likely to see those bigger year-on-year numbers. But later in the year, that's when it gets a little bit more challenging and gets a lot more interesting in terms of how monetary policy plays out, and also what the US economy is looking like at that point. Because it's all well and good for them to say to consumers, "Oh, well, prices are only rising by 4% or 3%," but they're already behind the 8 ball in real terms, and wages aren't growing that fast for most people either. So it's going to be interesting.
Yeah, interesting is a very good word. Unpredictable, I would suggest.
Very much so. I mean, we don't know what's going to happen. And to be completely honest with you, this is sort of based on the baseline of where things are going at the moment. If we see an acceleration of Omicron in China, and we see further lockdowns like we've seen in Xi'an on a larger scale, if we see, Beijing, Shanghai, you see the ports go back into lockdown on a larger scale, this basically blows what I'm saying out of the water and just disregards it entirely, because, China is the world's factory. If you look at most of the things in your house, it says made in China on most of them. Even if you look at things even more like high-end things like your car, even if you've got like a relatively expensive luxury car, a lot of those little widgets that make up your car are made in China. So, that could elongate those supply chain issues for quite a long time to come, potentially years, if this continues to be an issue.
Absolutely. And that's the other point, isn't it? A lot of this stuff is going to have a long tail to it. So it's not like it's suddenly going to be fixed, in a few months' time. These things are going to take probably a generation or two to shake out.
Indeed. And just to very briefly comment on, if we do see issues in Kazakhstan, if those issues continue to escalate into more widespread problems and potentially beyond, and we do see disruptions to oil and gas supplies and even uranium supplies, you could see inflation start to take off, energy inflation start to take off further, much in the same way it did when there was issues in the Arab world in the late 1970s, with the fall of the Shah of Iran. So, it's just really, really unpredictable at the moment, and it's definitely something worth keeping an eye on.
Yep, absolutely.
Okay, now there is this narrative in the media in Australia and in the US that basically people spending their savings that they've accrued during the pandemic is going to save the economy, is going to make everything fantastic, is going to ensure that things are propped up. Now, in the US, the savings are now finally being spent in the last few months that it's been occurring, but they're only being spent at around about a rate of $10 to $15 billion a month, with an average of around about 12. Now, $12 billion a month, while it sounds like a whole heap of money, when you factor in that it's the US economy and it's the $23 trillion economy, it's really a drop in the ocean, particularly when you contrast it with the fact that those, the child tax credit and the student loan repayment holidays are coming to an end, both of which far outstrip the impact of people spending their savings, at least so far. And for those wondering about Australia, I went through APRA's data last night, and the level of household deposits has not yet reduced. It is continued to rise. So households are not yet spending their deposits in net terms.
Yeah, and interestingly, of course, there's a distribution question too, because it's not equally residing across all households, right? There's about 20 or 30% that are doing very well and have big savings, but there's a lot of people who have no savings. And that distributional aspect of this is one that I don't think is fully understood, certainly in the mainstream.
No, and I think part of the issue is that we do lack data. In the US, there is much, much more extensive data on who holds what in terms of income and wealth demographics. I mean, the survey data that I've seen, which is obviously much less sophisticated and much less detailed compared with these, broader undertakings by, government in the US to sort of better quantify this. About 19% of Australians don't have any major savings. I believe it was under $500, and basically, I mean, obviously there are people above who in higher income and wealth demographics and who are middle class, etc., who may have some savings, but by the same token, they need to feel comfortable spending it. Even the wealthy need to feel comfortable spending it, because when prices are rising, people tend to save because I mean there's this idea that inflation means that people are going to go out and buy, but we don't have the same world that we did in the past. Like in the 1970s, if you wanted a fridge, there was no afterpay. There was no, oh, I'm just going to chuck it on the never never, or the easy availability of credit. So I think it's going to be interesting in that regard, and I've actually got a few interesting slides on that later in the show.
Yeah, okay. No, that sounds very interesting. And, one of my observations, again, is that the unequal distribution is there. The other thing I'm seeing in my surveys, I had them this week, is that people's confidence levels are actually deteriorating again because of the bug and everything else that's going on. So I do think spending and confidence are highly linked.
Absolutely. Speaking of confidence, U.S. consumer sentiment is currently weaker than when Lehman collapsed. That's a hell of a headline. It's not actually one I've seen anywhere else, which is interesting. And it's fascinating. And also, I should point out that this predates the big run-up in Omicron cases in the US. So this is almost exclusively driven by the impacts of inflation and the other issues in the US economy, not by the virus. And it's quite an ugly picture. And also, there's also another good chart kicking around that shows that basically consumer sentiment used to be a very, very strong predictor of where the stock market would go. That if consumers were more bullish, the stock market became more bullish. But since the big QE explosion, that hasn't really been the same way. Its stocks have gone to the moon, and consumer sentiment has deteriorated to head down towards GFC lows. And it's not a pretty picture. And if Omicron does prove to be challenging, or even if just inflation continues to take off, it may continue to deteriorate further.
Well, all the evidence suggests that confidence does drive a lot of decisions in terms of purchase decisions, particularly, for example, large purchase decisions. But again, I'd make the point that confidence is not equal among all household cohorts. And once again, in Australia, we don't have very good data looking at confidence levels across the different segments. I do have some of that in my data. And I can tell you that those who are actually at the more affluent end tend to feel more confident and therefore more likely to spend. But there are very large cohorts whose confidence levels have been dented over the last 2 or 3 years, who continue to see no increase in wages. And now we've got this next cycle of difficulty coming through. They potentially have less capacity to spend, but they're an important proportion of the total population. And I'm not sure you can build the complete economy on just a small affluent segment spending.
No, absolutely. Now, this takes us back to that interesting issue about inflation and even the returns on inflation from the bank. Now, the euro area savings rate is actually rising, despite the fact that the real, as in inflation adjusted returns on 10-year bonds have been mostly negative over the past 4 years. People are saving more, not saving less, because they're not getting the returns from those investments, because you used to be able to look at things and go, okay, well, if I've got, say, €500,000 and I invest that and I get 4%, 5%, I can retire through my pension fund. But now with returns so paltry and basically real returns deeply negative, people are saving more and more and more. So it's a really interesting paradox, and something that potentially we're going to confront here in Australia. Perhaps, I mean, maybe not. Aussies do tend to be a bit of a different breed in that regard, but perhaps elsewhere in the world.
I think it's probably true to say it's here too. As you say, there are some differences, and the number of people in the economic quarter that claim that there is a unique set of situations here in Australia, so you can't read across from other geographies into Australia. I'm afraid I think that's overblown. I think there are some very important parallels. It's just that maybe we're at a slightly different point in the cycle, but I'm not sure that we are that unique.
No, I think in terms of underlying psychology, probably not. But I just think that, say for example, the property prices go to the moon narrative, which has unfortunately been reinforced again and again and again by government and RBA intervention. For a lot of these people, it's like, well, why would I save? Why would I sell my investment property and put money into the bank or whatever when I can just ride the bubble to the moon? So, I wonder if that potentially plays some form of role in Australian savings rates. Because if you compare savings rates between Australia and the rest of the world, Australian savings rates are frankly abysmal. Because once you rip out super out of the equation, it's really not that impressive.
No, that's right. The super is a big chunk, but it's not an accessible chunk. And I don't know whether you saw, there was a very interesting McKinsey report that came out, I think, in November, looking at this issue of global savings. But they drew a very strong line between rises in global savings and rises in property prices. So, in fact, for a lot of people, their savings base is effectively the price of their property, which has gone up, right? But of course, that's a theoretical value. It's a paper value until you actually go to sell it. So it's a very illiquid way of saving. And it actually, I think, leaves people quite exposed. What happens if things do change and property prices do slide back? You could suddenly find that the affluence that you thought you had dissipates.
Indeed, and part of the issue with that is that because we don't have a free market property market, we have the issue whereby if and when property prices do really take a massive hit, and they will eventually, because nothing lasts forever. Now that could be 5 years now, 10 from now, 10 years from now, 15. I don't know. It could be sooner. It could be far off in the future. But nothing lasts forever. But when eventually it does happen, the government and the RBA would have expended so much ammunition in trying to prop it up that what's going to be left in terms of the real economy? How are people going to be able to rebuild their wealth, rebuild the economy, rebuild a productive economy? And that's one of the things that concerns me the most. Just that it should have been allowed to fall in 2008. It should have been allowed to fall in 2020. Yet we're left with this situation now where if it does all fall apart, it's going to do even more damage than it would have before, and the economy is even more reliant on it. We talk about the U.S. and stuff like that, about the child tax credit and all that sort of stuff. Yet the cash out home equity withdrawals in Australia are worth 3 times Obama's stimulus in terms of GDP, and 3 times those two programs every single year. And that's happening regardless of whether or not the economy is falling to bits or not. So, our economy is addicted to that. So it's really just hard to see how it all plays out in the end.
Well, the issue will be that governments will try and keep it going further. One of the reasons why I think there's limited upside in terms of interest rate movements is because, of course, if you put rates up, then this starts to come unglued. And I did put out a tweet earlier on today reminding people that APRA is still planning for banks to be able to cope with negative interest rates early, not this year, but next year, right? So just over a year ago, a year into the future, because actually the only lever they've got is to go even lower in interest rates.
Well, exactly. The likely next 2 ports of call, and we've discussed this in the communities, discussed this extensively on Twitter, is negative interest rates and raiding the super piggy bank, because there's nothing really left in the conventional monetary and fiscal policy sense, because we've already exhausted it. Okay, sure, maybe you can throw some homeowner grants at things and do something like that, but eventually you just hit the law of diminishing returns, because the grants just end up being such a small proportion of an overall property price. Like, you think about when Rudd threw the money at the market and compare what percentage that would cost, how much that would cost now for the same proportion of a property price. It's a completely different world, despite the fact that the budget base hasn't grown by nearly as much.
Absolutely. And of course, the fact is that you've got to go on pumping more and more in, not in a linear fashion, but in a logarithmic fashion to get the same result. So in other words, you've got to go on getting bigger and bigger and bigger in terms of your stimulus programs to be able to support the economy on this mode of engagement.
Yeah, exactly. Well said. Now, this one I thought was kind of interesting because there's this narrative going around that, sort of like, Chinese manufacturing is booming. It's going to continue to boom on the back of stimulus and yada, blah, blah. And I think it's really fascinating to see that small manufacturers in China have been struggling for years. And they've been struggling since the pandemic began for most of that time. And for most of that time, the sector's been contracting. And that's fascinating considering the fact that we've seen this enormous stimulus wash from the Western world into Chinese factories, and it just hasn't really been helping those small businesses who need it. And that is an absolutely key point for the Chinese government and for the Chinese economy going forward, because these businesses need to be supported because they employ the vast majority of Chinese. I'm talking about small businesses in general, not just those in the manufacturing sector, but they employ the vast majority of people in China. So that is something that needs to be taken into account when people go, oh, but they're going to do X or Y amount of stimulus. Yes, well, part of that stimulus is going to go towards propping up small businesses because it's not politically viable to not do so.
No, absolutely. And there are some important decisions for the Chinese government over the next 12 months, right? And so they want to make sure that they're in a position to support the local economy, and that means local households, local businesses. So I think that'll be a very prime focus for them.
Indeed, and just to comment on China more broadly, there's this idea that they're going to pull back from this property crackdown, and will pull back slightly. Sure, there's evidence that could occur, but by the same token, you've also got those Evergrande towers in Hainan province, which they apparently illegally obtained the permits for, being demolished, despite the fact that they're worth $1.7 billion. Now, if I was going to bail out a company and bail out a sector, I wouldn't want to kick them in the nuts for $1.7 billion, because that's $1.7 billion that you're going to have to come up with. So, they're still being quite punishing in that regard. And, I realistically don't see that stopping anytime soon. And I mean, just yesterday, another Chinese developer worth billions that up until December was considered investment grade and tip top and all this sort of stuff. One of the best placed developers in China, just defaulted on over $100 million in debts. And now all their creditors are coming banging on the door saying, we want early repayments, we want our money now. And there's the potential for contagion. So that particular saga is far from over.
I agree. The contagion question is a very important one. And, the more you look at it, the more you realize just how wired into the economic prosperity of China the property sector is. And, I can understand why they're trying to unpick it, but it's a very delicate operation.
It is. And I mean, like I say on Twitter and elsewhere, you can't taper a Ponzi. And, that's something that Michael Pettis has said a little bit more diplomatically on Twitter, the China expert from Peking University. And, he's basically said that, you can't stop. I mean, the Chinese property market is an entirely speculative market, even more so than Australia. It's like Australia, on steroids and meth and everything combined, turned into this giant monster that sucks in 30% of GDP. And basically, you can't take away the punch bowl because people are entirely reliant on speculative gains to basically pay for these properties. So that's a real problem, because a poll the other day showed that 56% of people in China now believe that property prices are going to stay flat, with the remaining 44% either split between saying that they don't know or that they believe that prices will rise or prices will fall. But in a country reliant on a speculative mania, you need them to keep rising. Them not falling isn't good enough. So that's what's going to be really, really interesting as Chinese local government tries to stabilize housing prices, putting a bit of floor under things, and so telling people, no, you can't sell your property for less than a certain price because we say so.
And of course, the other point there is that the sale of new properties has stalled. I mean, I think the statistics were that Evergrande's almost sold nothing since sort of September, October time. And that means there's already a huge break, as well as the fact that they're not completing necessarily the ones that they should be completing, although they seem to be under now more of an obligation from the governments to at least complete the ones that they've contracted to complete. It's going to be messy, it's going to be long, and as you say, it's such a large proportion of the economy that it can not go along the route they're taking it without significant consequences.
Indeed, and as you say, and the thing is, regardless of what they do, there are going to be consequences, and that's something that's going to be really interesting to watch for. Because on one hand, if they continue down the road they're going, eventually commodity prices that are reliant on the Chinese property sector, like iron ore, are going to get whacked. Because right now they're pricing in a fairly significant stimulus based around the property sector. But then by the same token, if the Chinese property sector does get into really dire straits and the CCP panics, you could see very, very strong demand for commodity exports, and it could once again save Australia from itself. So, like we've been talking about throughout the show, it's really up in the air at the moment.
Absolutely, the iron ore thing is quite interesting, right? Prices are higher than they were, but still a lot lower than they were a few months ago, and nobody quite knows where it's going to go next.
No, I mean, they are pricing in a very significant stimulus. They're still well above where they were last year, even amidst a fairly sizable property stimulus, but the market seems to be expecting even more. And personally, I don't think they're going to get it. But, we'll just have to wait and see. Now, this is the rate hike thing I was mentioning earlier. And basically, we've got very nearly a full rate hike priced in for July here in Australia, and a 75% chance of a rate hike by the Fed in March now, and a one fully priced in for April. So, rates are going to be rising a whole lot sooner than a lot of people thought. And I mean, even just on the rather hilarious side, you've got a 4% chance of a double rate hike by the Fed in March, which would really put the cat amongst the pigeons.
Yeah, but it's interesting because, again, we're finding here and overseas, the markets are tracking quite differently in terms of their rate expectations relative to what the central banks might be saying that they might be doing. Now, the interesting question is who wins that argument, right? Because 2 or 3 years ago, the Fed started down a journey and then had to stop because basically the markets won. I will be interested to see who wins this time, because central banks tend, in my view, to say good stuff from the market perspective, but sometimes they don't follow up with reality. But the markets also tend perhaps to overemphasize some particular perspectives as well. So again, another course of uncertainty ahead.
Indeed, and I think that the key thing going forward is really going to be the US employment numbers, but really the US CPI is going to be a major driver of global markets going forward, because if it continues to surprise to the upside, if we do continue to see those supply chain pressures putting upward pressure on the cost of living, then the Fed really doesn't have a choice in terms of continuing to push that tightening route. But by the same token, if we do start to see the CPI start to decelerate later in the year, it could give them a little bit of breathing room compared with some of the more sort of hawkish predictions. So, it's really going to be quite interesting because it's all up in the air.
Yeah, and it's interesting talking about up in the air. Frydenberg gave an interview today to the AFR, basically saying he's supportive of an inquiry into the RBA. Very interesting. After the election, of course.
Yes, of course. And of course, what is the inquiry into the RBA going to be performed by the RBA? Is it going to be performed by Treasury, or I don't know. I'm not familiar, but it's just something. I mean, it's like when the Prime Minister's office investigates things on behalf. The Prime Minister's office investigates the Prime Minister's office, or the Prime Minister allows a Liberal MP to investigate their own conduct. It's like, oh, they're not. We found that we've done no wrongdoing. It's like, well, I'm shocked.
Well, I think we should get the Council of Financial Regulators to do the inquiry into the RBA. How about that?
I don't know. Is there going to be a moment with Kenneth Hayne and Josh Frydenberg sitting across the table with Kenneth Hayne looking unhappy? Because if so, I think I'd rather save the money.
Yeah, and this is interesting, of course, because Phil Lowe pre-positioned this and said, well, maybe there should be an inquiry into some of the tools that they used, implying they didn't need to ask the big question, just the small questions about the use of tools, which is, I think, a perfect misdirection story.
Well, I mean, I suppose you don't get to be good. You don't get to be the governor of a G20 central bank without being at least a little bit good at misdirection, I suppose. Okay, now this is the last one for the day, and I think it's probably, I may have saved the best for last on this one. It's the G5 credit impulse versus the earnings of the S&P 500, and as you can see that there is quite a strong relationship between the two, and it's really fascinating to see, because if this is in any way correct, their earnings are going to have a bad time. So it's really going to be fascinating to watch this all unfold over the next 12 or 18 months, because it's just not, neither here nor there, because you've got Wall Street saying earnings are going to keep going up, earnings to the moon, but then you've got a fiscal cliff, and you've got all these other sort of, you've got inflation dragging on the economy, dragging on spending. Real inflation adjusted spending peaked 9 months ago in the US. So it could get quite challenging for the market from an earnings perspective. So it's going to be a fascinating one to watch.
Well, it goes right back to the point where I came in, which is that the markets are absolutely priced for perfection, and they believe that the Federal Reserve will save them. But the reality is, if you look at the real numbers, and if you look at what it takes for companies to continue to perform, doesn't work, and particularly with higher rates, of course, the discounting effect on future earnings is significant, which means that effectively the price-earnings ratios for most stocks are probably overstated by 20-30%, and that's why there are some people out there thinking that, well, this is potentially the harbinger of a significant correction for the markets, and the only thing that stands between it and it happening is the Federal Reserve and other central banks just doing more quantitative easing. That's the only backstop we've got, which is not necessarily a good place to be.
No, and part of the issue with all, with the market more broadly, is that it's all well and good for them to say that earnings have grown really strongly in 2021. It's like, well, yeah, you threw all that extra. I mean, people say, oh, but people said in 2020, the end of sort of September, October 2020, that they were bearish, and that they thought that things were going to deteriorate in 2021. I was one of them. I agreed. But then they turned around and threw even more money at it. You can't say, oh, well, you were wrong. And it's like, yeah, but you got an extra $5 trillion in stimulus. You can't get 25% worth of GDP, well, very nearly 25% worth of GDP, in additional stimulus, and then start complaining about the fact that other people got it wrong. It's like, the goalposts were moved from here to New Zealand, and I think that's going to be something that's going to be really interesting this year, because the fiscal policymakers may not be coming to the rescue this time because of inflation.
Well, that's exactly right, and I have the view that the inflationary pressures that now central bankers are waking up to means that they will be hobbled in terms of what they can do. So I guess, looking forward, there are a whole bunch then of uncertainties. And, we've often said, there are so many different uncertainties that it's hard to pick what's going on. But one of the ones that's really interesting to me, and it's a bit of a microcosm, is this tennis star, and the fact that, Victoria basically let him in, and then the federal government said, no, and you haven't ticked the right boxes. This is a wonderful microcosm of the contention between federal and state and politics versus, you couldn't have a better story, could you?
It's honestly a train wreck. It is a train wreck where, there's different competing interests, where it's something, if I were Prime Minister, and this was occurring under my government, I would say, and someone asked me at a press conference, what's going on with Novak Djokovic, I would turn around and I would say, I refer that matter to the relevant spokesperson at the Australian Border Force or the Department of Immigration. I don't believe that it's my place to comment on an individual's case. Yet it's turned into a bloody political circus with everyone jumping around and trying to blame someone else. And, oh, it's this person's fault. It's Andrew's fault. It's Border Force's fault. It's Dutton's fault. It's just turned into a complete mess. And but I think that it's just emblematic of a society that's, I suppose, for want of a better word, for deep want of a better word, that's just broken. Like Omicron is spreading like wildfire. We've got nurses and doctors with Omicron working in our hospitals as we speak, because that is the challenge that is being prevented, and that's what it's taking to give people the care that they need. So to be completely honest with you, from my personal perspective, I'm not a Novak Djokovic fan. I don't really care about him, and I think that he's handled this poorly, very poorly. But by the same token, I really don't care. I care about the double standard that occurred for him to be allowed in the first place, and allow those other tennis players to be brought in the first place. But I don't really think that it really matters at this point anyway. I think that it's just it's spreading anyway. Everyone's getting it, and that sucks. But it's just, eventually you've just got to look at things and just be like, it is what it is, and if we do need to do things to protect the health system, if there are other things that have to be done, then I really don't think that Novak Djokovic is really a major issue here. I think that we've got to look at things like, making sure that people get the help that they need, and focusing on that rather than on, some tennis star and the political crap storm that follows.
And the point I was going to make was, this is another classic case of misdirection, right?
Yeah.
Because if you're talking about tennis stars and what they're doing, you're not talking about some of the broader issues that we've touched on, which we should be talking about. So there's so much misdirection going on. There's so much, trying to sort of point us over here. Look over here, all these shiny things over here. Never mind the things over there that are really important, because I don't think the question about whether a particular tennis star is playing tennis in Australia or not is, well, it shouldn't be on the front page at all, frankly.
No, I completely agree with you. And, that was something I was saying on Twitter, it was either yesterday or the day before, that basically no one's talking about the shortage of, the headlines today are not about the shortage of rapid tests, and not about the fact that the testing centres are closed, that in some cases people are still waiting 5, 6, 7 days for a result, which is having a serious effect on businesses. Now, it's all well and good to say, oh, but, we should do X or Y in terms of policy. But, in terms of, because I know that it's turned into a bit of an ideological battle, how we handle COVID. And that's something that I don't really want to get into at the moment. But looking at it purely from an economic perspective, you've got all these places that are closed down, all these cafes, all these restaurants, all these shops that are closed because people can't go to work because they're waiting on test results. Yep. And that is an absolutely huge issue. So looking at it purely from an economic issue, purely from a let's get money in the pockets of people and protect small business owners, it's an issue. And it's something where the government should be getting absolutely hammered on. But, it's just, it's like you said about the divide between state and federal with, very different testing outcomes in different states. It's a mess.
Absolutely. And just remind everybody, in the first phase of COVID, there was 50 billion or thereabouts misspent by the federal government in all of their various programs, right? Now that money would have been much better spent on some of the things that should have been done more recently to essentially keep the economy going. But no, this time around, they're not interested.
Yeah, well, it's a bit of a case of premature stimulation, unfortunately.
Very good. Oh, yeah, absolutely. But it is, absolutely. And the money's went to the wrong place. Taxpayer money, went to the wrong place. Deficit's still very big. And the only thing that they can do, of course, is to turn around and say, well, of course, the economic fundamentals are great here. I would say, well, that may be if you're in a particular segment of the economy and if you're in a particular business community, maybe. But most people would not believe you.
Well, the question is that, okay, let's just take that claim that is no doubt going to be made at face value. that's how things look today. How are things going to look in 2 weeks' time or 3 weeks' time if this continues to drag on? If we continue to see even supply chain issues with having enough eggs and meat and stuff at the supermarket,
Yep.
how are things going to look? When these businesses have gone weeks and weeks without revenue. When these staff haven't been paid. What is the economy and what is consumer confidence going to look like then? I know that we've got through this relatively well, but that's because we've thrown over $500 billion at the economy.
Yeah,
and actually that's stopped.
Yeah, and absolutely. And the other thing to make, I think, if you look at the percentage proportion of, say, GDP that we threw at it, ours was bigger than almost all other Western countries.
Yeah, and we managed the virus better than most other Western countries up until that point too. So, that's one of the reasons why things have remained so strong for so long. It's one of the reasons why the property market remains so strong for so long. Even the used car market as well.
Absolutely. Well, as we sort of sidle up to this this first month of the new year, I have to say, Tarric, that there are lots and lots of moving parts, all moving in different directions. There's very little logic to what's going on at the moment, and I guess we'll have to just keep our finger on the pulse and call it out as we see it.
Yeah, well, more is the same as always, mate.
Well, thanks for your time today. Really appreciate it, and we'll do it all again soon.
Yeah, no worries, mate. See you soon.
See ya. Bye-bye.
Bye.